All right, so if you're looking at the Bitcoin chart right now and you're getting this, I don't know, this massive sense of déjà vu, trust me, you are not alone. You can almost feel it, right? There's this nervous energy in the air, this feeling like, hey, haven't we seen this movie before? So the big question is what we're seeing really a repeat of the past? Let's dive in and figure it out.
And I mean, look, on the surface, the comparison it's pretty unsettling. The chart pattern we're seeing today, here in March 2026, it looks eerily similar to that pattern we saw right before the big market collapse back in 2022. And that memory, that's what's fueling so much of the fear right now. It's kind of like the ghost in the machine that everyone's worried about. But the question is, are we just looking at shadows here?
Okay, so to really figure out if history is repeating itself, we can't just get spooked by the shape of a chart. No, we have to go deeper. We have to actually dissect what caused that 2022 crash. We've got to understand the blueprint of that fear, you know? What were the ingredients?
And the thing about 2022, it wasn't just one thing. It was a literal perfect storm. You had three massive factors hitting all at the same time. First, you had a huge geopolitical shock with the war in Ukraine. Then, you had inflation just raging out of control. And the third piece, the real kicker, was a Federal Reserve that was openly, and I mean openly, hostile to the market.
And that last part, this idea of a hostile monetary policy, that is the absolute key to this whole thing. It means the Fed wasn't just, tapping the brakes on the economy. No, they were slamming them to the floor. They were aggressively jacking up interest rates and literally pulling money out of the system. That's what they call quantitative tightening. It was basically a declaration of war on inflation, and you know who got caught in the crossfire? Risk assets, like Bitcoin. So, what was the result of that perfect storm? A devastating, jaw-dropping 77% collapse in Bitcoin's price. Wow. I mean, that number right there, that is the anatomy of the fear we're talking about. It shows you exactly what happens when you mix geopolitical panic with a central bank that's actively working against the market. Okay, so now we have the blueprint. We know the ingredients for the 2022 disaster. So the question for us, right here, right now, in 2026 is pretty simple. Are all those same ingredients in the mix today? And this leads to a really, really critical point. What if the most important ingredient is missing this time? What if that crucial third element, that hostile Fed, the one that turned a dip into an absolute catastrophe, what if it's just not here? What if it's completely absent from today's equation?
Well, when you look at the data, the difference is literally night and day. Let's break it down. Back in 2022, the Fed was just starting to aggressively hike rates. Today, we're in a rate-cutting cycle. In 2022, quantitative tightening was just getting started. Today, it's over. It officially ended back in December 2025. And maybe most importantly, the whole mindset of the Fed's leadership has flipped. It's gone from a war on inflation to a pro-growth agenda. The entire environment is the polar opposite.
A huge part of this is the new Fed leadership. The new chair, Kevin Warsh, he's operating on a totally different philosophy. He's got this belief that the massive productivity boom we're seeing from AI is going to act like a natural brake on inflation. And what does that do? It frees up the Fed to focus on growth. So think about it. This isn't a central bank that's an enemy of the market anymore. It's one that's actually trying to be an ally.
All right, so we've established the Fed's policy is completely different. But what does that actually mean when fear and panic hit the market? Well, lucky for us, we don't have to guess. History gives us some really clear examples of what happens when a geopolitical shock runs into a supportive Fed, not a hostile one. Let's go back to January 2020. We had a major geopolitical shock with the Soleimani events in Iran. Fear spiked for sure. But what was the Fed doing at the time? They were super accommodative. We had zero interest rates, and they were doing quantitative easing. So what happened? Bitcoin had a quick little dip, and then it not only recovered, it actually rallied. That supportive policy was like a massive tailwind that just blew all the fear away.
Or hey, let's look at something more recent. October 2023. Another big geopolitical shock hits. Bitcoin dips about 5%. But here's the thing. The market was already expecting the Fed to pivot, to become more supportive. And what was the result? The market recovered in just 16 days, and then ripped higher on a massive 32% rally. You see the pattern here? It's super consistent. Supportive policy tends to win against geopolitical fear.
So all of this brings us right back to where we started. Today, March 2026. We've taken apart the 2022 crash, we've looked at other times in history, and now we can start putting all those pieces together to get a much clearer picture of what's going on.
So, what's the big takeaway here?
Let's boil it down. Look, the geopolitical fear out there, it's real. We can't and shouldn't just ignore it. But, and this is the most important part, the underlying monetary policy environment is the complete opposite of what we had in 2022. And as we just saw, history shows that this kind of supportive policy, it acts like a powerful buffer. It's like a tailwind that consistently, time and again, overpowers short-term panic. To put it simply, policy is the game changer.
Which leaves us with one last big question to think about. As you see all the scary headlines pop up, as you see those charts that look so familiar, the key is to ask yourself this. In this environment, with a supportive Fed, is all this headline fear a real warning of another 2022-style crash, or is it maybe just a distraction from the much more powerful underlying policy trends that are actually driving the market?
Definitely something to chew on.